Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chan, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Today, I have a guru here who is bringing this US mortgages to Canadians. And so I want to interview him for my own purpose. And I have a lot of clients who are interested in buying properties in the States. As a matter of fact, I just hosted a webinar last night talking about this specific topic, the tax implication side. Obviously, I'm not into mortgage, so I can't really talk about that. That's why I have Scott here. Scott Dillingham is a longtime friend as well as a mortgage broker, and you have found Land City for a long period of time now.
Yeah, Land City's been about 5 years now, and previous to that, I was at a major bank for nearly 10.
Oh wow, you've got quite a bit of experience.
Absolutely.
So, you are Canadians? You are Canadian?
Well, I'm dual citizen.
Oh, okay.
I'm US and Canadian.
So, do you own any properties in the States?
Not yet. However, literally before I got here, I'm working with a realtor right now, putting in an offer on a property.
Oh, amazing. So, but you live in Windsor.
Yes.
Yeah. So, how do you go about qualifying for mortgages?
Yeah, so I mean, it's super easy in the States. So for a Canadian listening, you're very much used to using your income, looking at your debts, looking at your credit score. So in Canada, the approvals, they're all about the borrower on the residential side, I should state. Okay? So it's all about the borrower. But in the US, it's kind of like the commercial side in Canada, where it's 90% about the property and 5 to 10% about the borrower. So ultimately, you can qualify based on the cash flow and strength of the property and not your personal income.
Okay, so I guess this would be awesome if you can tell us a little bit about that. What's that mean? Because I'm a Canadian and I don't have any credit history in the US. So, I mean, I get lots of emails from RBC telling me that I can use them to qualify for a mortgage to purchase a US property. But that is not true US borrowing, right? That RBC credit or the product that they are going to, the mortgage that they are going to lend me is going to also register in my name. So in the US, it will be registered in my US credit report as well, I'm sure. But so for us, Canadian, the number one question is, are we qualified? Can we qualify for mortgages to buy properties in the States?
Absolutely. So a couple things, just because you mentioned RBC. So the thing with RBC and the other banks in Canada that do this, it is based on your personal income as well. So they can give you the loan as long as you've got the income to qualify. The negative that I think, and you know from a tax perspective, but RBC is going to close in your personal name. They're not going to allow an entity to close. And just from a tax perspective, Cherry, what does that look like? And then I'll answer your question, but what does that look like if you close in your personal name?
Well, you report everything in your personal name, right?
But you're double taxed, right?
Yeah.
Essentially. At least that's what I'm hearing. I don't know.
How is it double taxed though? If you report the income in your personal name, then you deduct the interest expense.
Okay.
It's not double taxed.
So it's not double taxed.
It's not double taxed.
Okay. See, and that's why she's the expert. So that's why we're here.
No, well, the reality is that it is registered in your own personal name in Canada. If you want to buy another property in Canada, a portion of your credit is now being tied up to buying this U.S. property, right?
That's right. That's right. So then with this product, the U.S. lending product, they're not looking at your income at all. So what they're doing is they're seeing what the property rents for. So let's just say the property rents for $1,500. They're going to look at the mortgage expense. They're going to look at property taxes and homeowners insurance costs, if there is a homeowners association attached to the property, like a gated community kind of thing.
Yeah, like condo fees.
Yeah. So if the rents cover those expenses, then you're approved. Yeah. That's how easy it is.
Okay. So it sounds really easy. It sounds like everyone can get it. Is it true? Because I was telling the webinar audience last night that we need to set up a structure to protect your liability. I mean, that's what I was told by the US lawyers anyway, because people in the US has a higher likelihood to sue other people.
Yes.
So it's important to protect your net estate. So it's important to set up a structure.
Yep.
Now, to set up a structure, it could mean setting up a corporation. It could mean setting up limited partnership. So
Yep.
these are complicated structure. And in
Yep.
Canada, it is really challenging to get a mortgage. Well, not really challenging, more challenging to get a mortgage in a corporation, let alone
Yep.
getting a mortgage in a limited partnership.
Yep. You're right. In the States, it's completely opposite. So the States I see as very business friendly, right? They're very open for business. And so C Corp is actually what the lenders like. A C Corp is the number one entity they want you to have.
Yeah, okay.
So if you get a C Corp, every lender over there will move forward as long as the property covers itself. From there, the next entity that they prefer is an LLC. Then below that is a limited partnership. And then lastly under that is the personal name. So we can still close deals in the personal name, but that's the hierarchy. So if you're going to get a C Corp, then you can qualify for all of the lenders, and that just enables you to get better interest rates and better terms.
Okay, so now that you mentioned interest rates, before I get there, because everyone wants to know about the rates as well, C Corp is essentially the Canadian corporation equivalent, right? But it's a US equivalent of Canadian corporation.
Yeah.
So now we all know in Canada to get a corporation-owned mortgage is harder, at least on the residential side, unless you're working in the commercial term. So in the US, it sounds like it's easy to get a mortgage in a C Corp.
Absolutely. Yeah, it's the easiest.
Yeah.
There's no. Yeah.
So what's the rate that we're looking at?
Well, so that's where it depends on the property. So literally, I'll give you a great example. I had a client refinance 2 condos in Florida. They were part of the same complex. Like the complex had 4 or 5 different buildings, and 3 were on one side of the street and 2 were on the other.
Yeah.
And so he had one across the street from each other. And the rate on those was 0.5% different, even though the appraisals and the loan to value he was taking was the exact same. So literally the zip code can have an impact on your interest rate. I'm seeing low 6s. I'm seeing as high as even 9%. 9% would be like a small loan that maybe you have to take an open mortgage. Because, you know, for an example, in Ohio, if the loan amount is below $111,000, then you have to get an open loan. So open loans, just like in Canada, they have a higher interest rate to them. So that's why it's such a range there.
Wow. Okay, so now we get the rate range over. What about loan to value? I mean, commercial mortgage is really based on rental income minus your property tax, minus your insurance, minus your condo fees, whatever that net amount would be able to substantiate the mortgage. And that monthly mortgage payment is used to calculate how much maximum they are willing to lend you. So it sounds like complicated. It is a little bit complicated because it's reverse. It's based on how much you can really afford within the property. But realistically, from your practice, how much loan to value are you really looking at? We're looking at my property in Texas. We paid $265,000 for it.
Okay.
It is a special deal. We assumed the mortgage, so we didn't get to work with Scott. But at the same time, I think the loan to value was really just 40%, 45%. But we have a local rate.
Yes. So couple options here depending on what you're doing, and I'm going to give you the answer for an American and a Canadian, because a lot of Canadians, they end up having a US family member or a US partner, so then you can qualify for different terms. So let's say the property has really good cash flow and you can qualify for all of the terms. If you have an American on the application, the max LTV is 85%.
Oh wow.
Which is awesome. If you don't, and it's just a Canadian, right, the max is 75% on a purchase.
Yeah.
When you refinance, the loan to values are less over there. So an American can refinance up to 80% maximum, and a Canadian, I've seen 70. I've seen a couple lenders do it at 75, but the rates were really, really high. 70 and below is where it's really competitive percent, like loan to value on a refinance.
Yeah. I mean, I know you say that it is low. To me, it's actually a peace of mind to have
Yeah.
lower loan to value being pulled out. I mean, learning from last couple of years of experience is probably not a good time to keep restructuring your equity, right? So I know also in America they have something called like I think a 40-year mortgage or something.
Yeah.
So tell us a little bit about that.
Yeah, so they have, I'm going to answer this with two answers because it's the 40-year, but they also have something extra if you get the 40-year, what it comes with. So what I mean by that is in Canada, right, we've got the 30-year amortization. Everybody's quite used to that. In the States, they have that too. But if you go with the 40-year, what they do is they actually take the first 10 years and they make it interest only.
Oh, wow.
So you're getting the first 10 at interest only, and then it starts the regular 30-year principal and interest.
Oh, cool.
So combined, it's 40 years. But that's what they do, and that's great too, because when you're buying properties, as you know, sometimes the beginning, you have to turn over the property. You have to renovate it, right? You have to install correct property management, find good tenants. So that interest-only period really helps to maximize the investor's profits, and then it switches to P&I later once you've stabilized the property.
So would Canadian or Canadian corporations, not Canadian corporation, but Canadians' own entity qualify any of this for any of that?
Like a Canadian entity owning it. So no.
Not a Canadian entity,
okay.
but up the chain of ownership, it's Canadians on the other end. It could be a C Corp owning it. It could be a limited partnership owning these properties. Would they be able to qualify?
Yes. So there's a couple different entity structures. If you're going to have a Canadian ownership at the very, very top, obviously the property has to close in a U.S. entity, but there are a few lenders that we work with that support that as long as you're 3 layers deep maximum. If you have this entity and that entity and you've got more than 3 layers, they won't move forward. So we can do that, but it's very few lenders that support that. So because there's less lenders, right, it means the terms, it's not as flexible, rates might be a little bit higher.
So, but then these entities would still qualify to get the 40-year term. Oh, awesome.
Yeah, so it doesn't matter. As long as you qualify for the mortgage, regardless of the entity, like it's got to be an entity the lender supports, but whether it's limited partner or C Corp, right, that's buying it, it's you get those terms.
Oh, amazing, amazing. Now, in Canada, we know that every 5 years we have to renew the mortgage term. But in the U.S., they allow for a longer time period if the term is not 5 years. I think a lot of our some of the commercial mortgages in Canada would support maybe a 10-year term.
Yes.
But what about in the U.S.? What are the options?
Yeah, great question. So the amortization in the States is the term.
Yep.
And yeah.
So it could be 40 years.
Yeah.
You can commit to the same rate for 40 years?
And it's amazing. Now here's the beauty of it, right? So because some people think like right now the rates are higher, right? In Canada too, they're higher than they were a few years ago. Same thing in the States.
Yep.
But some Canadians are like, well, I don't want to pay this high rate for 40 years.
Yep.
And not that it's high, right? I mean, 6.5, 7, it's not too bad, but right, if it's lower,
can always be lower.
Yes.
Let's just put it that way.
So what they allow you to do is by default, after 5 years, the loan becomes open.
Oh, okay.
So then if your rate is better, you just maintain it. And if something's better later, you can just refinance or change lenders and then get that new lower rate penalty free. So it's super cool.
So it's only after 5 years though. So if it is within 5 years, what's the cost of breaking that mortgage?
Well, that depends on the lender, and you can also select when your mortgage is open. So I could actually make it open from day 1, or I could say, you know what, I want it to be open after 2 years, and it will have a slight rate premium. But let's go back to your question. So the normal penalty, depending on the lender, there's either a step-down penalty or there's a flat 3% penalty. So the step-down is in year 1, you pay 5% of the loan as a penalty.
Yeah.
Year 2, you pay 4. Year 3, you pay 3, right? And it goes down until it's gone. Or you can do the 3%, where it's just 3% throughout the whole time period. And then at year 5, it's fully open.
I see.
It's pretty cool.
Yeah, absolutely. So interesting. It's something completely different, and the terms that they use would be completely different, even though they mean the same thing or we're just neighbor. It's very different. That's why we have Donald Trump versus Justin Trudeau equally anyway. Let's not mention that.
That's right. And another thought, if I may, is that like if you look at Canada in the past, let's call it 2 years, with the rates skyrocketing, even myself, I don't consider myself a victim, but even myself, like I had the variable rates, I believed in that product, then the variable rate went so high, my mortgage renewed, and now the property is no longer cash flowing. That problem does not happen in the States, even if their rates go up, because you get that amortization for that whole time. So as long as you buy and it covers itself during that time, you should be safe unless something drastic happened to the market and rents lowered, let's say. But if not, right, you're protected. So the high rates, even though they went higher, it didn't affect the US people like it did us over here.
So are you talking about just the people who committed to fixed rate, or are you also talking about people who committed to variable rate?
Really any, but the reason I got double hit with the variable is because my lender, the payment stayed the same.
Yeah.
So then I had a negative amortization because I didn't increase my payments.
Yeah.
So when the renewal came, I had to catch that up and then go with a new rate. So it was like a double whammy. Where if you had a fixed rate product, you wouldn't have had to catch up, you would have just accepted the higher rates.
So last night I did the webinar, and one of the most common questions that I got asked was, how do you build up the credit in the US so then later on you don't have to pay 7%, 9% interest rate? Is it even possible? Because we're Canadians, we're non-resident in Canada. Is it even possible?
Yeah, it is. So to be honest, I think the best way, and from when I'm speaking to the lenders, they actually want to see a credit card and they want to see a mortgage.
Oh, okay.
So a lot of these lenders in the States, the mortgages don't report to the credit bureau. So you can get what's called a VOM, is what they call it, which stands for verification of mortgage. So we can get that from the mortgage lender, and then that will prove a credit history, but it doesn't help build the score. So that's why you need a credit card. So there is a card with Amex, and I forget the name of the card, but if you literally Google Amex card for Canadians building US credit, you'll find it on there. And what they'll do is they'll take your Canadian credit and they'll approve you in the US based on that. So then you can get this card and that will help build your credit. Now, I will say most lenders, when we're pricing out a loan, it works out that they're pricing it as if you had a FICO score of between 680 to 700. So by getting a US credit score, right, their scoring caps at 800. So you're almost at the highest tier anyways. So the rate difference might be 1/4% all the way to like 0.5% difference. So it's not huge, but it will obviously help, especially if you're building a portfolio of properties.
So like going with that line, the chain of thought, because I told people that you need to have a structure to avoid double taxation, protect yourself, and all these things. So if I borrow money in my corporation or in my limited partnership, the registered entity on that mortgage is my limited partnership. It's not me personally. So how do I build that? Like, how do I structure it so then it makes sense?
Yeah, so I mean, like for your credit score, well, in that case...
Or it doesn't really matter, even going forward, if I'm using the same limited partnership to purchase properties, I should just build my credit score within that limited partnership.
That's right, and you're going to have an EIN number,
yes,
right, when you set up the main entity, and that EIN is where that credit history is going to report to. So that's what will help you for sure.
Okay, amazing. Now, I know that this is a lot of work for Canadians buying properties in the US as well. And for us, we need to help people set up their structure, talk them through what they really need, why there's double taxation, and all these things. It's the same with your line of business qualifying for mortgages. So I understand there's also generally there's a fee associated, whether you're located in the US or in Canada, there's always a fee on lending. What are the fees associated with like carrying on a mortgage?
Yeah, so I mean, the fees are going to vary lender by lender and even broker by broker, depending on how they've set everything up. However, I'm going to say the fees range from 0% to 3% on a smaller loan. And that's a buy and hold. Fix and flip loans, the fees are higher because in those cases, the lender also wants a fee. So I've seen those go to 5%. Now, the reason why some of them could be zero is the lender could build our commissions into the rate. So that might not always be the best. So we generally, when we're pricing a loan for an investor, we'll give them a few different options so they can pick. But 9 times out of 10, it's cheaper to pay a fee and to get the best rate than to accept a slightly higher rate with no fees, if that makes sense.
Yeah, absolutely. So for those people, for the fellow Canadians who want to qualify for a mortgage in the U.S. or refinance your properties in the U.S., how do they reach out to you?
Like, how do they contact us?
Yeah.
Yeah, so I mean, you can visit our website at lendcity.ca. Through there, there's a contact us page. You can book. So through the booking link, and here's how we've done it. So like, we've set LendCity up so that way if you are looking for a specific property type or investing strategy, it's there, right? So we have student rental experts on our team. We have developers on our team. So anyways, under that booking link is the US link. And under there, we actually have mortgage lenders on the team who also own US properties there to help you along the way. So you can book with them right through there, and then they'll help get you set up.
Awesome, fantastic. Thank you so much, Scott. You've provided a lot of great information here, and I hope that we would be able to have you present to our audience at some point down the road.
Awesome. Well, thank you so much for having me, Cherry.